Krispy Kreme, ticker symbol DNUT, has been one of the more interesting plays in the consumer discretionary sector over the past couple of years. It's a brand with a nearly cult-like following, a global footprint, and a business model that blends nostalgia with a modern distribution strategy. But the question for investors is this: is Krispy Kreme just a feel-good brand, or is it a smart long-term investment right now? Let's break it all down. First, let's look at the fundamentals. In its most recent quarterly earnings, Krispy Kreme reported revenue of $426 million, up 7% year over year. This growth was driven largely by its hub-and-spoke model, where large production hubs supply fresh donuts daily to a network of smaller spokes, including grocery stores, gas stations, and quick-service restaurants. This model has allowed Krispy Kreme to expand its presence without the high overhead costs of opening more retail shops. Net income for the quarter came in at $8.2 million, compared to $6.4 million in the same quarter last year. That's a year-over-year growth of over 28%. The company's adjusted EBITDA, or earnings before interest, taxes, depreciation, and amortization, was $53 million, representing a margin of roughly 12.4%. While that's not massive for a packaged food company, it's an improvement from prior quarters and shows operational efficiency is improving. From a balance sheet perspective, Krispy Kreme has total debt of just over $800 million, with a debt-to-equity ratio of about 0.9. That's a bit on the high side for a company in this space, but given its stable cash flow and brand strength, the debt is manageable. Free cash flow for the trailing 12 months was $48 million, which gives Krispy Kreme flexibility for reinvestment and modest shareholder returns. Now let's talk about growth catalysts. One of the biggest drivers for Krispy Kreme is its partnership strategy. In the United States, the company has expanded distribution through Walmart, Target, and Kroger, reaching customers in locations far from its traditional retail stores. Internationally, Krispy Kreme continues to grow rapidly in markets like Mexico, Japan, and the United Kingdom. There's also significant white space opportunity in markets like India and Southeast Asia. Another growth lever is digital ordering. Krispy Kreme has seen a double-digit increase in online orders and delivery sales, which is helping drive higher average order values. And then there's seasonal product innovation. Limited time offerings like pumpkin spice, holiday-themed assortments, and collaborations with other food brands keep customers coming back throughout the year. On the competitive side, Krispy Kreme has an advantage in brand equity. Unlike most bakery brands, it's not competing solely on price. It's competing on experience. The Hot Now sign, fresh donuts in store, and social media-worthy products make it a destination purchase. That gives it pricing power, which in turn supports margins. From a valuation standpoint, DNUT trades at around 28 times forward earnings, which is higher than the packaged food sector average of about 22 times. On an EV to EBITDA basis, it's trading at about 12.6 times versus the sector median of 11. So yes, the stock is slightly expensive relative to peers, but that premium is backed by faster growth and a brand moat that's difficult to replicate. For the technical picture, DNUT is currently trading in the $16 to $17 range, sitting just above its 200-day moving average. The stock has been consolidating in this range for months, building a strong support base around $15 and resistance around $18.50. A breakout above $18.50 could push the stock toward the low 20s, especially if the next earnings beat expectations. Relative Strength Index, or RSI, is hovering near 55, which suggests it's not overbought and has room to run. When we put it all together, the improving fundamentals, the global expansion opportunity, the strong brand moat, and the steady technical setup, Krispy Kreme looks like a compelling long-term hold for growth-oriented consumer investors. Now here's my buy recommendation and price target. Given the company's growth trajectory, margin improvements, and distribution strategy, I believe Krispy Kreme can deliver mid to high single-digit annual revenue growth with steady margin expansion over the next 3 years. Based on my discounted cash flow model and peer valuation comparison, my 12-month price target for DNUT is $21, with a more aggressive 24-month target of $24 if they execute well on international expansion and margin improvement. That represents an upside of roughly 25 to 40% from current levels. To be clear, there are risks, including commodity inflation, supply chain disruptions, and execution risk in new markets. But for investors who can stomach short-term volatility in exchange for long-term growth, Krispy Kreme offers a sweet combination of brand strength, strategic expansion, and improving financials. So bottom line, DNUT is a buy for long-term investors who want exposure to a consumer brand with a strong growth story and pricing power.